Hello, people. Welcome to this new chapter. In chapter 8, we're going to discuss risk and return and how exactly we measure risk and return. First of all, you should know there's always a positive relationship between risk and return in a healthy financial market. So, if there's a higher risk for any kind of investment, then the investor would require higher return, and the company would pay higher return. And if the investment, for example, like treasury bills, which is a very low risk, then the return will not be high either. So there's a positive relationship between risk and return. And you may think, what about some outliers? For example, if it's a high risk and low return, so what will be the result? The result would be that nobody would buy it. Okay, after everybody has learned it has a lot of risk but doesn't pay enough money, then people would walk away from such type of investment, and this investment would not get any money. Eventually, it will disappear. Okay, and also there may exist some investment that give a high return but with a very low risk. So that's very desirable. Then everybody would buy it. Okay, so everybody just swamp to to get a piece of it. So as a result, the price will go up just because everybody is buying it. The demand shifted, and that basically push up the price. And then if the prices are increased, then there is a less return for the following buyers. Okay, so when price just increase to high level, there's less room to make extra return. So for the next buyers, there's just a low return. So eventually, low risk investment would give you a low return. All right, so that's a conversion of those outliers back to high risk, high return, or low risk, low return. Okay, and talking about the risk and return relationship, first, a risk is estimated. Okay, so investors need to get a whole idea of this business. It's either a corporate or it's a limited liability company or any business project. Investors has to get a solid idea of the riskness this business is exposed to. Okay, and then the investor would require a certain level of return based on the risk level. Okay, because the investors want to be compensated for the risk they are taking, and then the investor would force the company to provide that return. If the company cannot offer a return that is higher enough for investors, then there is no investor at all. Okay, so basically, if investors require a certain level of return, then there has to be the firm has to offer that return. Okay, and not every investor is rational, so we have different risk attitudes in our population. So the rational ones would be risk aversion, okay, or risk averse attitude. So in this group of people, they dislike risk, so they would require higher return to encourage to hold riskier securities. And there's also a concept called a risk premium. Risk premium basically is a return. That is part of the return that is used to adjust the risk level. Okay, and that's the difference between the risk on the risky assets and a riskless assets. And this serves as a compensation for investors to hold riskier securities. And in a later slide, I will elaborate more about risk premium. Okay, so the risk averse is the right attitude, but there's also more irrational behaviors. So we have risk loving people. So these are basically gamblers. They love taking risk, and they would rather pay to gamble, although they know if they keep gambling on and on, in the long run, the probability is against them. They would lose money. They still put their fortune into the gambling business. Okay, so these are risk-loving people, and there is a scientific result basically states that human brain is invulnerable to risk-taking behaviors like taking roller coaster or go to casino to gamble. Okay, because that's part of the human nature, and just like a human are invulnerable to tobacco or liquor, so that kind of weaknesses. All right, and there's also risk neutral, which literally does not quite exist. Um, but we still need to learn there is such risk attitude that may exist. You basically, for this kind of investors, the risk neutral people, they are purely driven by return, and they just don't consider risk at all. Okay, so if the return is higher enough, they just go for it. They don't consider risk. And for the risk-loving people, risk is a plus. Okay, it's something they want to pay for. And for risk-averse people, risk is a bad thing. So they want to get paid for taking risk. Okay, so investors overall are risk-averse, and we're talking about rational investors, and we're talking about a mature, developed financial market like United States. Okay, so when there's higher risk, there should be higher return. But in China, it is different story because the Chinese stock market is fully denominated by individual investors, and 60% of them have no high school degree. So it's just filled out with investors with no right risk attitude. They just love taking risk, just like they like drink water or drink liquor or drink or smoke tobacco. So they are vulnerable to risk. So in the Chinese market, it's usually a high risk, low return. All right, that's just a side note I want to mention. All right, and if you look at this curve here, the vertical axis tells you about the return, and the horizontal axis tells you about the risk. E is the expected return here. STD is a standard deviation. And for risk-loving people, so for the higher risk, they want to be compensated lower. Okay, they want to be compensated lower, or less compensation would make them happy if they are taking more and more risk. Okay, you can treat it that way. Or on this side, you have risk-averse people, but people have a different risk-averse attitude. For more risk-averse people, for a small amount of risk increase, they would require high return for compensation. And for less risk-averse people, if there's a higher increase in risk, then they just require a small amount of a return for compensation. Okay, so these people are less risk-averse. Now let's talk about risk-free rate. So the risk-free rate basically is the rate you get no matter what, regardless of any economic situation. The only risk-free assets here is Treasury bills. Okay, it's issued by the Department of Treasury of the United States government. Okay, it is risk-free because the issuer, U.S. government, never default on its debt payment. All right, who has default on the debt payment? A lot of countries. Okay, like Syria, like Greece, like Argentina, like Russia, especially Russia. In the year of 1998, overnight, the Russian government just claimed they are not fulfilling any of their debt obligations. So for all the government bond issued by the Russian federal government, they are not paying back at all. Okay, so that was called a Russian debt crisis. Okay, but for U.S. government, they never do that. And in a risk-averse market, any investment should give an above risk-free rate. Okay, so let's say the U.S. government give a T-bill rate that promises a 2% return per year, then any investment should give a return higher than 2%. If an investment give a 1% rate, then this investment will not exist because no one would invest in it. Okay, as long as this investment has certain risk, if it is the return is lower than the government bill rate, then no one will invest it, so it will disappear. Okay, and here is a chart basically shows you the correlation between risk and return. So you have the basic risk-free rates, and every investment should give a return that is higher than that. And the additional part is called a risk premium. Okay, like right here, we have an investment that has this level of risk. Okay, this level of risk, so the return will be right up there. So there's a risk-free part that is contained with the overall return. There's also a risk premium part that is included in the overall return. Okay, so the risk premium is a part of the return used to compensate the actual risk the investor is taking. Okay, so once again, we are assuming the investors are risk averse. So higher risk, they want to be compensated by more return. And also, if you look at the risk-free part, you have a real return, which is dedicated by hard work, labor, capital investment, and also technology. Okay, this real return it indicates the true development of wealth. And you have inflation. So inflation is just the money printing activity by the central bank, right? So that does not contribute to real wealth. All right. So for corporate bond, this is from chapter 7 and also from chapter 6, which I did not quite cover. The bond yield basically is the return. Okay, the bond yield is determined by the risk-free rate. Okay, it's right here, and also by a number of risky factors. The primary risky factors would be default risk. So if the company default or goes bankruptcy, then the company would not pay would not pay back this bond. So that's the risk premium. And also the maturity of the bond contributed to the risk premium. So the longer time wait until maturity, there's more uncertainty involved. So investor want to be compensated more. And also liquidity is another premium because if the corporate bond is not easy to trade, then we call it illiquid. Then the investors want to be compensated, okay, for the hardship to trade the corporate bond.